The stock market has been a good forecaster from time to time in the past. It also has been a rather poor forecaster occasionally.
At 32 years old, Warren Buffett had already become a millionaire. Not through luck, not by inventing the next big technology, and certainly not by winning the lottery. While most people chase quick money, Buffett quietly built a fortune using a strategy almost anyone can understand, but very few have the patience to follow.
But before we dive into Buffett's incredible journey, don't forget to like this video and subscribe to the channel. Every week, we uncover the real stories behind the world's greatest entrepreneurs, investors, innovators, and visionaries. Now, let's go back to where it all began.
Warren Buffett was born in Omaha, Nebraska in 1930, during one of the most difficult economic periods in American history, the Great Depression. While many children spent their days playing, Warren was fascinated by numbers and business. At just 6 years old, he bought 6 bottles of Coca-Cola and sold them individually for a profit. Soon after, he was delivering newspapers on his bicycle before sunrise, saving every dollar he earned instead of spending it. Most 11-year-olds were spending their allowance on toys or candy. Warren Buffett was doing something almost unimaginable for a child his age, studying the stock market. Every evening, he would sit for hours reading financial newspapers alongside his father, Howard Buffett, who worked as a stockbroker. While other children memorized baseball statistics, Warren memorized stock prices, company names, and market trends. Numbers fascinated him. To him, they weren't just figures on a page. They were stories waiting to be understood. Then, at just 11 years old, Warren made his first real investment. He purchased 3 shares of Citi Service Preferred for $38 per share. 2 were for himself, and 1 was for his older sister, Doris. For Warren, this wasn't just spending money. It was putting his beliefs to the test. But almost immediately, things went wrong. Within days, the stock price dropped from $38 to just $27. Imagine being 11 years old and watching nearly a third of your savings disappear. Most adults would have panicked, and Warren certainly felt the pressure. Instead of selling immediately, he waited. Weeks later, the stock slowly recovered to $40. Relieved to see a small profit, Warren sold every share. He believed he had made a smart decision. But then something happened that he would never forget. Over the following months, the same stock kept climbing. $50, $80, $120, eventually reaching nearly $200 per share. Warren had been right about the company. He had simply been too impatient. Decades later, Buffett would still talk about that first investment, not because he lost money, but because he learned one of the greatest lessons of his entire career. The biggest fortunes aren't built by finding the perfect investment. They're built by having the patience to let great investments grow. That painful lesson, learned by an 11-year-old boy, would eventually become the foundation of one of the greatest investing philosophies the world has ever seen. That painful lesson stayed with Warren Buffett for years. He realized that making money wasn't just about choosing the right company. It was about having the patience and discipline to hold on to it. But there was still one question he couldn't answer. How do you actually know if a company is worth buying? Buffett spent the next few years searching for that answer. And eventually, he found it inside a book. The author was a man named Benjamin Graham. To most people, Graham was just a professor at Columbia Business School, but to Warren Buffett, he would become the most important mentor of his entire life. Graham had developed an investing philosophy that was completely different from what most people believed. While investors chased exciting companies and followed the latest trends, Graham looked for something far less glamorous: undervalued businesses. Companies whose true value was much higher than the price the stock market was asking. His philosophy was simple: the market isn't always rational.
Sometimes fear drives prices far below what a business is really worth. Sometimes excitement pushes them far too high. Graham believed that successful investors should ignore emotions and focus only on facts. Buffett was fascinated. He read Graham's book, The Intelligent Investor, over and over again, filling the pages with notes. Years later, Buffett would describe it as by far the best book on investing ever written. Determined to learn from the master himself, Buffett applied to Columbia Business School. There, he sat in Graham's classroom, absorbing every lesson. For the first time in his life, Warren Buffett felt he had found the blueprint he had been searching for. Learning from Benjamin Graham completely changed the way Warren Buffett looked at investing, but knowledge alone wasn't enough. He wanted to prove that Graham's philosophy could work in the real world. After graduating from Columbia, Buffett achieved what once seemed impossible. He was hired by Benjamin Graham himself to work at Graham Newman Corporation in New York. For a young investor, there was no greater opportunity. Every day, Buffett analyzed companies, searched through financial reports, and learned directly from the man he admired most. It wasn't glamorous. While many investors relied on instinct or market rumors, Buffett spent hours reading balance sheets, annual reports, and company earnings. He believed that behind every stock price was a real business. Somewhere inside those numbers was an opportunity waiting to be discovered. In 1956, Benjamin Graham retired. Buffett returned to his hometown of Omaha with little more than a reputation for being exceptionally good at investing. Instead of looking for another job, he decided to start his own investment partnership. It was called Buffett Partnership Limited. At first, very few people trusted him with their money. Friends, family, a handful of local investors. Together, they invested just over $100,000. Buffett himself contributed only $100, not $100,000, just $100. Yet he managed the partnership as if every dollar belonged to him. His strategy was remarkably simple. Buy exceptional businesses only when they were selling for less than they were truly worth. Ignore the headlines. Ignore market panic. Ignore the crowd. Focus only on value. Year after year, the results were extraordinary. While the average investor struggled to beat the market, Buffett consistently outperformed it. Investors began talking. More money flowed into the partnership. More opportunities followed. And then, in 1962, at just 32 years old, Warren Buffett officially became a millionaire. Not through gambling, not by chasing the latest trend, but through discipline, patience, and an unwavering belief that great businesses eventually reward those willing to wait. By the early 1960s, Warren Buffett had already built an extraordinary reputation. His investment partnership was growing rapidly, and investors trusted him more than ever. Then, in 1962, Buffett noticed a struggling textile company in Massachusetts. Its name was Berkshire Hathaway. At first glance, it looked like a terrible investment. The textile industry was declining, profits were shrinking, and many investors believed the company had no future. Buffett agreed. He never intended to own Berkshire Hathaway. He only wanted to make a quick profit. Buffett noticed something unusual. Every time Berkshire closed one of its textile mills, the company used the remaining cash to buy back its own shares. That pushed the stock price slightly higher. Buffett realized he could buy shares cheaply, wait for another buyback, and sell them for a profit. It seemed like an easy opportunity. But then, during one negotiation, Berkshire's management offered to buy Buffett's shares at a specific price. Buffett agreed, but when the official offer arrived, it was slightly lower than promised. The difference wasn't enormous, but Buffett felt deceived. Instead of selling, he did something nobody expected. He began buying even more Berkshire Hathaway shares, not to make a quick profit, but to take control of the entire company. Everything changed. In 1965, Warren Buffett became the controlling shareholder of Berkshire Hathaway. Looking back, Buffett would later describe buying the textile business as one of the biggest mistakes of his career. The textile operations continued losing money for years, but instead of giving up, Buffett transformed Berkshire into something completely different. Rather than focusing on textiles, he used the company's cash to buy stakes in exceptional businesses, insurance companies, banks, consumer brands, businesses that generated consistent profits year after year. Without realizing it, Buffett had accidentally created the perfect investment machine. By the late 1960s, Warren Buffett had already achieved what most investors could only dream of. His partnership was thriving. Berkshire Hathaway was beginning to take shape, and yet one conversation would completely transform the way he invested. That conversation began with a man named Charlie Munger. The two first met in 1959 through mutual friends in Omaha. Almost immediately, they realized they shared something unusual. They weren't interested in chasing market trends. They weren't interested in getting rich overnight. They were obsessed with understanding businesses. At the time, Buffett was still heavily influenced by Benjamin Graham's philosophy: buy companies that were cheap, even if the businesses themselves weren't exceptional. Graham believed that if you bought $1 for 50 cents, you would eventually make money. And for years, Buffett followed that strategy with incredible success. But Charlie Munger saw a problem. He believed that constantly buying average businesses at bargain prices meant Buffett would always have to sell them and search for the next opportunity. Instead, Munger proposed something radically different.
He famously told Buffett, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." That single sentence changed everything. Buffett slowly shifted his entire philosophy. Rather than looking only for companies that were cheap, he began searching for businesses so extraordinary that he could hold them for decades. Companies with products people loved, powerful brands, loyal customers, predictable profits. Businesses that would still be thriving 20 or 30 years into the future. Looking back, Buffett would later say that Charlie Munger expanded his thinking far beyond Benjamin Graham's original teachings. Graham had taught him how to invest. Munger taught him what to invest in. Together, they built one of the greatest business partnerships in modern history, and the world was about to witness the results. By the late 1980s, Warren Buffett's investing philosophy had fully evolved. He was no longer searching for struggling companies selling at bargain prices. Instead, he was looking for exceptional businesses with products people already knew and trusted, companies that millions of people used every single day. Then, in 1988, Buffett made one of the most famous investments in financial history. He began buying shares of the Coca-Cola company. To many investors, it seemed too obvious. Everyone already knew Coca-Cola, so why buy it? Buffett saw something others underestimated. Coca-Cola wasn't just a soft drink. It was one of the strongest brands on earth. Every single day, millions of people chose Coca-Cola over every other alternative. The company had built decades of customer loyalty. It operated in countries all over the world. And perhaps most importantly, people kept coming back. Buffett invested over $1 billion into Coca-Cola. At the time, it was considered an enormous risk. Many critics believed he had paid far too much. Buffett disagreed. He wasn't buying the stock for the next year. He was buying the business for the next several decades. That investment would eventually generate tens of billions of dollars for Berkshire Hathaway. And Coca-Cola wasn't the only example. Buffett continued investing in companies with products almost everyone recognizes. American Express, Moody's, Apple, Bank of America. These weren't random choices. They all shared the same qualities: strong brands, loyal customers, consistent profits, businesses that could continue growing year after year. Buffett often said that his favorite holding period was forever. It
sounded almost impossible, but he wasn't joking. While many investors spent their days buying and selling, Buffett simply waited because he understood something most people never do. Wealth isn't built by constantly chasing the next opportunity. It's built by allowing exceptional businesses enough time to grow.
Today, Warren Buffett is regarded as one of the greatest investors in history. His fortune reached tens of billions of dollars, not because he chased trends, not because he took reckless risks, but because he understood one simple truth. Time is the greatest asset an investor can own. Throughout his life, Buffett proved that extraordinary success doesn't require extraordinary intelligence. It requires patience, discipline, consistency, and the courage to think differently from the crowd. Even after becoming one of the richest people on Earth, he continued living in the same house he bought in Omaha back in 1958, a reminder that true wealth isn't about showing people how much you have. It's about having the freedom to live life on your own terms. His story isn't just about making money, it's about making better decisions, one at a time, for decades. And perhaps that's the greatest lesson Warren Buffett has to teach us all.